Portfolio Construction and Risk Management. Chapter 15. Building a Long-Term Investment Framework. Section 5. Long-Term Consistency. A long-term plan only helps if you can actually stick with it when markets feel great and when they feel awful. Often the biggest damage comes not from a single loss, but from abandoning a sound process in a moment of fear or excitement. Consistency gives your allocation, rebalancing, and underlying fundamentals time to do their job. Consistency does not mean tuning out the market or pretending nothing is happening. It means you keep paying attention, but you respond through rules instead of mood, headlines, or guesses about every turning point. That structure is what helps you manage outcomes without constant improvising. Discipline gets easier when you build into the system. Rebalancing nudges your risk back toward target by trimming what has run up and adding to what has lagged, while dollar cost averaging builds the habit of investing without waiting for the perfect moment. Simple tools like these reduce the pressure to be right all the time. One of the easiest traps to fall into is recency bias, where whatever just happened starts to feel like the only thing that matters. Strong headlines and short-term performance can make normal volatility feel like a reason to redesign everything. A durable framework expects periods of discomfort, and patience is part of the price of long-term investing. A good process does not need to be complicated. It just needs to be clear enough that you can follow it under stress. Set specific rebalancing triggers, separate routine monitoring from actual decision-making, and write the rules down so they are not changing with your emotions. Then review the strategy on a calendar, not in reaction to every market swing. When you feel a strong urge to break your plan, the most valuable move may be to pause. Write down why you want to act, give it a little time, and then test whether the concern is truly about your goals or just about market noise. That space between feeling and action can dramatically reduce emotional trading. Take Jordan as an example. He keeps a 70-30 stock-bond mix, invests a fixed amount every month, and rebalances every 6 months or sooner if the allocation drifts too far. If stocks fall and his mix shifts off target, the rule tells him what to do. If stocks surge, the rule still tells him what to do. The point is that the same process applies in both declines and rallies. Consistency does not mean never changing your strategy. It means changing for durable reasons, like a new time horizon, different spending needs, or a real shift in risk tolerance, not because recent winners look tempting or the market feels noisy. A sound strategy should be judged over long stretches of time, not over a few stressful weeks. A practical way to test your process is to write a short rule card and keep a simple decision log. Choose your drift threshold, set your review schedule, decide on your contribution plan, and make note of why you acted or chose not to act. If your rules still hold up when markets get uncomfortable, that is a strong sign your framework is built to last.